Good day, fellow investors. Our stock analysis playlist for 2025 has already 39 videos. And most of those have been included in our value investing quadrant, but in this video we'll go through the stocks discussed, just quick takes, and then through that process make a selection of the top 10 best stocks that we have discussed this year. Just a quick note, there are plenty of bots and scammers in the comments. If you want to contact me, ask me some questions about research platform or this, just send me an email at investwithsven@gmail.com. So let's immediately start with the analysis, with the lists. Of course, the link to the playlist will also be in the description below. The most recent discussion we have had is a complete analysis of the whole Magnificent Seven. And I said that if I had to buy one stock from there, that would be Amazon. But of course, I wish it would be cheaper. Now the market cap is 2 trillion. Recently, it was 1 trillion where I told you that it was pure value. However, the price is pricey, which means that if we look at low risk to higher risk when it comes to investing, Amazon should still deliver a good return long term. You have to expect volatility, and that is something that we'll implement later in the strategy and building a portfolio. So nothing wrong with Amazon, still a great business, e-commerce, web services, all the things that Amazon has been doing, but relatively pricey, especially from a margin of safety perspective. And who knows, perhaps tariffs might create better investing opportunities. Now, we have discussed Adobe. There were a lot of comments saying how it is a terrible customer experience and business. Everyone hates paying, and then they prefer switching to other things. So we discussed that mode. The last few years have been exceptional in that creator economy. If there is a slowdown, then Adobe is still pricey, in my opinion. Coal stocks have also recently been discussed, especially the US coal producers. There is something here very important. When it comes to coal US producers, when you look at their presentations and conference call, they all say how they are the low-cost producers, low cost. Then I listened to other coal producers like Glencore that recently acquired a Canadian met coal producing tech part. And they say that US producers are actually high cost because also of the transport, tariffs and things like that. And when you look at things, you understand that it is not really low cost as they say it is. If we look at the cheapest there, Warrior Met Coal, it is already interesting, but keep in mind, we still need to watch this quarter where from last quarter, prices of met coal were around 200, and now we are already at 175. 175, perhaps tariffs, reciprocal tariffs and things like that, higher even costs for US producers, which means that we could see even negative profitability. This was a zero last quarter, negative for this company, and then that is the risk and reward. If coal prices go lower, this can also go lower, but if coal prices rebound, this goes higher. However, still too much risk from this perspective. Vital Farms egg prices are booming, and so did the stock. It is down 30%, but it is up even more over the last 5 years. The management has been selling a third of the company here, thus even they think it is overvalued. We will simply wait for lower egg prices, a little bit increased hen production, and then we'll take another look at the company if things will again look qualitatively from a business fundamental growth perspective. Interactive Brokers is a stock that we analyzed already a year and a half ago. Since then, the stock significantly boomed. It is down a little bit, but I would say it now fairly priced at a P ratio of 25. I have a link to Interactive Brokers. If you click in the description below, you support the channel and you can check this global broker if you are looking for global investment, cheaper opportunities. HP, HPQ, yes, great. P ratio of 7, P ratio of 10, cheap. But if there is a recession, if there is less AI spending cloud, then it can look very, very ugly. We have discussed Carrefour, European retailer. I always say there is this competition, always new competition, hard on margins. And a common question is Target. Sven, what do you think about Target? The stock is down, what's this, 66%. The valuation now looks good. The dividend is interesting. They are working on a strategy that will increase sales by 15 billion, but they expect earnings per share around 8 to 9, so that is their P ratio. But when I look at the numbers, their margins, gross margins, declined 25% already in 2024. And that is the problem with retail. Suddenly, competition, you need to low prices just to achieve sales, to sell your inventory. Inventories have gone up. And therefore, for me, retail is still on a too hard pile. It can rebound, but we have also seen other retailers, Walgreens, Boot Alliance being taken over, things like that, where it simply doesn't end up well. And therefore, again, retail, too hard pile. We have discussed Uber, Bill Ackman's buy. He thinks the stock will explode in the next few years. However, if you look at robotaxis, this and that, and fleets and coming, the long-term environment there is extremely uncertain from a value investing perspective. I also think that Ackman is more going onto the bet side of things in order to increase his not stellar, still good, still great, but not stellar performance. And these things, these discussions, political, are more, again, back onto his ego. Berkshire Hathaway stock analysis, a deep dive, great business, Warren Buffett, cash, all holds, hedge, everything wonderful, except the price. If you look at Berkshire, the market cap is 1.1 trillion. You can see here the boom. I think above the long-term trend that the stock should, let's say, offer, there is 300 billion in cash. So that can still be deducted from a valuation if you want to watch from that margin of safety, but still 40 billion of yearly value creation, and then times 15, which is the usual suspect P ratio, you are at 600. So maybe this is a little bit too exuberant, fairly priced a little bit, and then huge bargain if it goes 30-40% lower. If we go to our quadrant, Berkshire, I have priced it here for a 4-5% long-term return, but with very low risk because of the quality of the business. S&P Global, great business, rating agency, doing well in this financial environment, but P ratio 40 is simply too expensive. Now, the chemicals, I have analyzed them and I said the 7% yield is great. Since then, the yield went from 7 to 8% as the stocks continued to go down. Now, let's put this on the quadrant, and yes, we are now at 8% return, but extremely risky because there is simply no competitive advantage. All these companies compete for the same market, for the same price taking, and therefore when there is just a little bit less demand on higher increased supply, then nobody makes any money and there are also losses. So if you really want a great buy there, but we'll discuss that more into the portfolio strategy. If you want a great buy there, wait for the dividend to be cut and then for improvements in inventories, things to start improving a little bit, and that is the great time to buy into their stock market cycle. Now, food stocks, but let me correct myself, food brand stocks. They are selling processed brands, not real food. And we have discussed Kraft Heinz, Nestle, Hershey, all P ratios around 20. The stocks seem stable a little bit. Kraft Heinz also down a little bit over the last time. The dividend yield there is good. Nestle rebounded, for example, a little bit, but I'm finding it hard to see where will this be in the next 5 years. private labels, increased competition, maybe less consumer spending, cheaper options, things like that. And then the growth that these businesses have enjoyed over the last decade and more might be gone. I don't know, but I'm not going to risk it at the average P ratio of 20. Now, a positive risk and reward story, ASML. If half of AI and chips and everything is true, then ASML is a buy now on the risk and reward. I've calculated, or you can check the analysis, that perhaps in the next 5 years the margin of safety at this price, if there is just one reversal, then you can see this at 1,200, which is a 2x. So the risk and reward is positive, the likely return is positive as the stock is reaching fundamental cheaper levels. However, in the short term, anything can happen into the semis, negative sentiment, and therefore I have put it here, good return, but keep in mind the volatility. Ford Motor, automotive companies, they simply can't catch a break. If there is a recession, sales might go lower, and you simply never get a good return. Everything always looks that cheap, thus I skip the automotive industry in general. Now, ADM, deep dive here, I urge you to watch this video. The dividend yield is here 4.2%, 51 years of dividend increases, and it is unlikely that they will cut the dividend because their business model is based on it. However, you always have these boom in the food industry, busts, boom, busts, boom, busts, boom, and busts. And we are now another downturn, and then the strategy there is, okay, we'll see also later, start a position. It is likely that over time, over this long-term trend, you will make money. Plus, you get the dividend while you wait. Another food-related business, CNH Industrial, from David Einhorn, and you can see already rebounding a little bit. If sales improve, if things improve, then when there is the next food boom, also the stock will likely improve. In the meantime, you hold a good company. We discussed also Google, how risky it is, the new capex, and if I look at the stock price, Google is the cheapest of the Magnificent Seven. The stock is going down, but when I look at this, I use more and more ChatGPT. I don't even search anymore on Google for pages. Well, I do, but the situation there makes Google a business that can be disrupted. Yes, there is YouTube, there is this, there is that, but maybe it will stay stable, maybe it will even grow. However, there is a big maybe. And at the P ratio of 20, it's still a bit too risky maybe. At the P ratio of 10, 15, maybe another year, 2 years of stability, or even growth because they are still growing 10%. Google, from a risk and reward, is the cheapest of the Magnificent Seven. Might be interesting, but I'm still waiting for that long-term, let's say, moat-worthy name on it. We've discussed also shipping. Shipping stocks go up and down, dividends, this and that. Watch that story if you want to know more about shipping. Not really for me, because you have these booms, busts, and when things really go bad, you cannot, as a retailer, go and buy the ships at a quarter of value. Verizon stock, good dividend yield, and now even improving from the bottoms, so those that collected over time now have enjoyed good returns. The dividend yield is now down from the 7%, but keep in mind that will always follow also the US Treasury. When it was 5%, 7% Verizon, now it is closer to 4%, 6% Verizon. So, like a bond, we could say. Verizon, 6% now on the dividend. It was a little bit more here, but it is a stable dividend payer there. We have also discussed oil stocks, Devon Energy. The stock is down as oil prices retreated, and this is just a bet on oil prices. It will be up or down. A more stable oil producer is Occidental, the Buffett oil bet. And here also down, but the free cash flow now are already yielding above 10%. They still have 2 years of debt repayments when they can start increasing the dividend, doing buybacks. And therefore I have put it here, okay, now we are at 10%. We need to keep it risky because if there is an oil downturn, recession or whatever, we can see better entry prices. But this is already good for Buffett, so it might also be good for us. Sibanye, the precious metals, and I said that it is offering a 5x potential and the stock is 40% up since I made the video. But it is always a risky one and I don't understand whether or how long or how ugly it might get. A dividend ETF, much better than the S&P 500. And I discussed how there is the dividend, there is some real growth there in dividends, and I have put it here now on an average long-term return of around 5%, stable, nothing wrong with it. We have discussed Ph.D. group. It is down in that, let's say, first cycle downturn, already at 10% cash flows. The risk here is that iron ore prices go down in a recession, copper prices go down in a recession, and then you might find it really cheaper for a while. Don't forget, all of this can be also compared in our intrinsic value table. I see that I have Petrobras, Petroleo Brasileiro, which also offers a good return here. We have discussed it in a video, and if we check it, we see that there is a good dividend. And even if the dividend doesn't grow, it still offers a huge return at a 13% dividend yield going forward. Of course, it will depend on oil prices, but keep in mind it is, yes, volatile. However, that depends on how big your exposure will be there. JDP, it's also very interesting coffee stock that we discussed. It's already significantly up since we discussed it. Rubis, I haven't made a video yet, but good 8-9% dividend yield. Caribbean and Africa oil distribution, that's a stable business there, even if it has its own issues. And you can see everything compared here, the intrinsic value compared to the stock price with the ratio there. If it is above 1, you might expect returns above 10%, which is what we strive for. If it is below, you follow and wait for the situation there. So don't forget to also look at the Petrobras video if you're interested in that company. Continuing on our quadrant, here is Petrobras. So 13% yield, dividend yield, but risky because if oil prices go down, this can get ugly. Of course, this can get beautiful if oil prices go up, but that is the risk and reward. Let's discuss the portfolio allocation. Now, when it comes to the portfolio here, let me first discuss reality. This is my research platform, and of the YouTube stocks that I have discussed publicly, there we touched a little bit on Amsterdam commodities. Archer Daniels Midlands has been analyzed in full, Berkshire as more expensive, BHP, a video has been released yesterday, but still waiting for those better opportunities. And then these are the covered stocks where I have a premium intrinsic value comparative table. Rubis has been discussed here and there. And I think Glencore is on free preview, so you might check that out too. However, I have 3 portfolios diversified with 17-18 position. Here there is a 3% position in Archer Daniels Midland. Here, personal portfolio, I have not any of the stocks discussed, and model portfolio, just a 1% position in Archer Daniels Midlands and 3% in Amsterdam commodities. This is my reality. However, if I would need to put this into a portfolio, first I would put it into segments. Stable, let's say, stable situation, great business but expensive, and then more risky and good returns. And I have also put here the S&P 500 just for a reference. I think the returns will be low, and therefore it is a high risk situation. Now let's put this into the portfolio. Small position if you just want to learn to know a stock. 1% of a portfolio, you buy something because when you own something, then you really know it. Without owning it, without owning a business, a stock, a small part of it, it's very hard to know it. Medium position, good return with some risk, and you already increase the exposure. If there is a catastrophic situation, you can buy more. And then full position, there is value, there is margin of safety, there is already a good return, and you say, I cannot believe how cheap this is. From that perspective, a small position, I would open it, let's say here, if we put 3%, medium position, Verizon, ADM, Glencore that we discussed, and then a full position in the treasury because you cannot go wrong, and perhaps wait for other opportunities. So this would be my idea of an imaginary portfolio on the basis of the 40 businesses and more 50, as we made also lists that we discussed. Now, why this 64% in cash? Because all the other opportunities are on my research platform. So 21-day money back guarantee, for the context of what we do here on the YouTube channel, I always urge people to check that.